long-term financial soundness of any business can be judged by its solvency ratio. The creditors, those who are the long-term creditors, those who provide funds for the long-term basis more than a year, can test the solvency and the ability to pay the interest regularly and its ability to repay the principal as per schedule by calculating the solvency ratios. The solvency ratios include debt equity ratio, debt service or interest coverage ratio, fixed asset ratio, debt to total fund or solvency ratio, reserve to capital ratio, capital gearing ratio, and proprietary ratio. Let us first understand what is debt equity ratio. Debt equity ratio is also known as debt to net worth ratio. It establishes a relationship between borrowed funds and the internal funds of the company. So, the formula is debt equity ratio is equal to total long-term debt divided by shareholders' fund. And long-term debt includes all the debt except current liabilities. It can also include redeemable preference capital. And shareholders' funds include ordinary share capital, non-redeemable preference share capital, credit balances of profit and loss account, free reserves, because all the profits and reserves belongs to the shareholders. But deduction should be made for any fictitious assets from the balance sheet. So shareholder funds or the net worth is equivalent to owner's equity minus fictitious assets. Another version of debt equity ratio is also known as external internal equity ratio, which is equal to external equity divided by internal equity. External equity is the total debt and internal equity is the shareholders' equity. Total debt is equivalent to short-term debt plus long-term debt. There is one more version of debt equity ratio which is known as debt versus funds ratio. Here, the debt equity ratio will be total long-term loans divided by total long-term funds. And total long-term funds is equal to total long-term loans minus equity. Let us take one example. From the following, calculate the debt equity ratio. 11,000 equity shares at rate of rupees 10 each comes to 1,10,000. General reserves are 50,000. Accumulated profit is equal to 35,000. Debentures 80,000. Sundry trade creditors 50,000. Outstanding expenses 15,000. Now we have to calculate debt equity ratio, which is equal to total long-term debt divided by shareholders' fund. And long-term debt is debentures 80,000 and shareholder fund is equal to equity shares plus general reserve plus accumulated profit means 1,10,000 plus 50,000 plus 35,000 equivalent to 1,95,000. Applying the values in the formula, we get debt equity ratio is equal to 80,000 divided by 1,95,000 means 0.41 is to 1. It means if the owner equity is rupees 1, then the debt which the company has raised from the outside market is 0.41. Now let us calculate the second version of debt equity ratio, which is external versus internal equity. External equity in this case is debentures plus trade creditors plus outstanding expenses, which is equal to 80,000 plus 50,000 plus 15,000. That is 1,45,000. And internal equity is equal to equity capital plus general reserve plus accumulated profit means 1,10,000 plus 50,000 plus 35,000, 1,95,000. So debt equity ratio according to second version is equal to 1,45,000 divided by 1,95,000 equal to 0.074 is to 1. And the third version of debt equity ratio can be calculated as total long-term loans divided by total long-term funds. And the total long-term loans in this example is the debenture worth 80,000, whereas total long-term funds is equal to equity capital plus general reserve plus profit plus debentures. This is equal to 1,10,000 plus 50,000 plus 35,000 plus 80,000 means 2,75,000. So debt equity ratio will be 80,000 divided by 2,75,000 equal to 0.29:1. The second ratio in this category is debt service or interest coverage ratio. Interest coverage ratio shows how many times the interest charges are covered by the earnings of the firm. This ratio is calculated as earnings before interest and taxes EBIT divided by fixed interest charges. Let us take one example. If the net income of an enterprise is Rs 1,80,000, its fixed interest charges on mortgage debentures amounting to Rs 30,000 and the income tax paid by it is 1,80,000. You are required to calculate interest coverage ratio. तो इंटरेस्ट कवरेज रेशियो कैलकुलेट करने के लिए फर्स्ट ऑफ ऑल वी रिक्वायर अर्निंग बिफोर इंटरेस्ट एंड टैक्सेस. Earning before interest and taxes here in this case will be net income 1,80,000 plus tax paid 1,80,000 plus the interest paid 30,000. So the total comes to 3,90,000 and fixed interest charges are 30,000. So the interest coverage ratio is equal to 3,90,000 divided by 30,000 means 13 times. To cover the interest by 13 times of its earnings. Next ratio is fixed asset ratio. Fixed asset ratio establishes the relationship between long-term funds and the fixed assets. Since the financial management advocates that the fixed assets should be purchased out of the long term only, that is why we need to check whether the fixed assets are financed from the long-term assets or not. So the formula will be long-term funds divided by net fixed asset. Next is the debt to total fund or solvency ratio. This ratio can be calculated as total liabilities divided by total assets. It establishes the relationship between total liabilities and the total assets. Here, the solvency means the financial position of any business which is capable to meet the outstanding obligation from its own assets. Next is the reserve to capital ratio. This ratio establishes the relationship between reserves and capital. Higher proportion of the reserves shows the financial soundness because the unit shall be able to meet the future losses as and when suffered. And secondly, the unit can also diversify. So the formula will be reserves over capital. Next ratio is capital gearing ratio. This ratio establishes the relationship between capital plus reserves, that is equity, and fixed cost bearing securities. Fixed cost bearing securities include preference capital, debentures, long term mortgage loans, जिनके ऊपर हमें फिक्स्ड रेट पे इंटरेस्ट देना होता है, जो हमारे लिए फिक्स्ड कॉस्ट बन जाती हैं. सो इस फिक्स्ड कॉस्ट का जब हम इक्विटी के साथ रिलेशन एस्टेब्लिश करते हैं उसको हम बोलते हैं कैपिटल गियरिंग रेशियो. Highly geared ratio means the lower proportion of the equity and lower geared ratio means the higher proportion of the equity as compared to the fixed cost bearing capital. And the formula is capital gearing ratio is equal to equity divided by fixed cost bearing security, where equity is equal to equity share capital plus free reserves plus profit and loss account credit balance, and fixed cost bearing securities is equal to preference capital plus debenture plus long term loans. Last ratio in this category is proprietary ratio. Proprietary ratio establishes the relationship between the proprietary fund to the total resources of the unit, where proprietary funds refers to equity share capital, preference share capital, reserves, surpluses. Let us take one example. This is the balance sheet in front of your screen and you are required to calculate the proprietary ratio. On the liability sides, we have preference share capital, equity share capital, reserves and surpluses, debentures, creditors. On the asset side, we have fixed assets, current assets, goodwill and investment. So let us calculate the proprietary ratio. First of all, for proprietary ratio, we will have to calculate the proprietary funds and then the total assets. Proprietary funds is equal to preference share capital plus equity share capital plus reserves and surpluses. That means 1,50,000 plus 1,50,000 plus 60,000 means 3,60,000. Total assets are 5,40,000. So the ratio is 3,60,000 divided by 5,40,000. That is equal to 0.66 is to 1. But sometimes accountant exclude intangible assets out of the total assets. If so, then the total assets in this case will be 5,50,000 minus goodwill of 20,000 means 5,20,000. So the proprietary ratio will be 3,60,000 divided by 5,20,000 means 9 is to 13. So the proprietary ratio will be 3,60,000 divided by 5,20,000 means 0.69 is to 1.